Good morning, dear students. Welcome to the home mentoring session of accountancy. Myself, C.S.K. Khanna from the ST Vidya School, Ambala Kent. Dear students, we were continuing to the topic of change in profit sharing ratio among the partners. And in this particular lesson, we had learned that what the reconstitution of firm is, what are the circumstances under which there is reconstitution of the firm. I had also shared with you that what type of the adjustments are required to be done at the time of change in the profit sharing ratio. We had also learned what is sacrificing ratio and gaining ratio, how these ratios are to be calculated. We had also learned what is goodwill and how we should make the calculation of the goodwill or valuation of the goodwill. And we had also learned three very important methods for calculation of goodwill, that is average profit method, super profit method, and capitalization method. In today's class, I will continue with the same lesson and share with you that how the goodwill is to be calculated under the different methods and also what the accounting treatment of goodwill is to be done. Then we will proceed for the next important segment of this same lesson. Let's understand question number 6. It states that ABC are partners sharing equally. They agreed to admit D for equal share. For this purpose, goodwill is to be valued at 3 years purchase of the average profits of the last 5 years. What it means? That goodwill should be equal to the 3 years, that is multiplied by 3 to what? To the average profit of the last 5 years. And for the last 5-year profits are given to you. You will notice that in the year 2015 there is loss of 20,000. So this loss will be subtracted, and then the total profit for the 5 years is to be undertaken. That is divided by 5. Then you will get the average profit. And what the average profit will be, you have to multiply by 3. But keep in mind, while taking the average profit, you have to make the every year profit normal. Normal here means that if there is any abnormal loss or abnormal gain, or for any other item the provision has not been made in that year profits, you have to first adjust them and make the normal profit, and then you have to find out the total and the average profit. See here, a very important information is given. On 1st October 2016, a computer costing 40,000 was purchased and debited to office expenses account, on which depreciation is to be charged at the rate of 25% per annum. Now, dear students, understand a very important element that is here. What it say? That on October 2016, a computer costing rupees 40,000 was purchased and debited to office expenses account, on which depreciation is to be charged at 25% per annum. Now this is some type of an item which is not been adjusted with reference to the accurate adjustment. Now what the accurate adjustment is here? See that we had purchased the computer, and this computer is an asset, but we had debited to them in the office expenses. Now what the result will be there, that 40,000, this which has been debited as office expenses in the profits of the concerned year, that is for the year 31st March 2017, it shows the profit less because we had debited them to the office expenses by mistake. Rather, what we have to do, that we have to charge the depreciation at the rate of 25% per annum, not 40,000 to be debited to the office expenses. And again, when you charge the depreciation at the rate of 25% on 40,000, please keep in mind that it should be calculated for 6 months, not for the full year. Why 6 months? Because the computer is purchased on 1st October 2016. So the result of this will be that 35,000 being net effect, which is to be added back as the abnormal loss, you could say, or for the abnormal item, then the normal profit comes out rupees 2,20,000. Once again, I share that by mistake, what we had did, a purchase of an asset, because computer is an asset, the cost of which was of rupees 40,000, being debited to office expenses, which is not to be debited, and we have to do what? We have to charge the depreciation on this computer at the rate of 25% per annum, which by mistake we had not charged. So what actual effect will be there? That 40,000 to be added back to this and 5,000 to be subtracted from the profits of year ending 31st March 2017. Result will be that the normal profits come for this year rupees 2,20,000. Then very simply what we will do, we will have the total of all the 5-year profits net to this loss. Keep in mind that the loss of this particular year, that is for 2015, to be subtracted, then you will get the total profit of 6,10,000 divided by number of years 5. You would have the average profit accordingly 1,22,000, and then multiplied by 3, that we have to calculate goodwill equivalent to the 3 years of the purchase of the average profit. So the result will be that goodwill equal to 3,66,000. Regarding the computer and its treatment for depreciation, I had already shared with you. So you have to keep in mind that the profit should make normal, and if there is for any abnormal profit, that should be added back, and if there is subtracted, and if there is any abnormal loss, that to be added. Let's discuss one more question relating to the calculation of goodwill under the super profit method. Question say, a firm earned profits of rupees 80,000, 1 lakh and 120, 120 and 180 during the preceding years. The firm has capital investment of 5 lakh. A fair rate of return on investment is 15% per annum. Calculate goodwill of the firm based on the 3 years purchase of the average super profits of the last 4 years. So what we have to do? We have to find out the goodwill equivalent to what? Based on 3 years purchase of the average super profits. You have to find out average super profits, and super profit means the actual or average profit less the normal profit. For that purpose, what you have to do? You have to find out first the normal profits. How you will find the normal profit? Normal profit will be finding out by the amount of capital investment and the rate of return on that. So in the business, there is investment of rupees 5 lakh, rate of return is 15%. So you would calculate that 75,000 is the normal profit. Now you have to find out the average profits. For the last 4 years, total profits comes to 4,80,000. When they are divided by number of years 4, you would have the average profit of 1,20,000. You had the normal profit of 75,000. So automatically when you subtract the average profit and the normal profit, 45,000 will be the super profits. Again, that the average profit is 1,20,000, normal profit is 75,000, then the super profit is 45,000. Then this super profit will be multiplied with the number of years purchased, that is 3. So the amount of goodwill comes out rupees 1,35,000. So this way you have to find out the goodwill amount in case of the average profit method as well as in case of the super profit method. I would also share with you one question relating to the calculation of the goodwill on the basis of the capitalization method. Now again understand what we have to do under the capitalization method. We have to understand that how much capital is required for particular profit earned, that may be average, super or the actual profits. See here, one very simple question once again I share with you that how you are going to understand this. Find out the capital implied from the following information. Very simple question, but ticklish question, understand. Here what we have to find out? We have to find out the capital implied. Normal rate of return is 12%. Profits are given for the 3 years this. goodwill valued at 3 years purchase of the super profits. See here that goodwill is given here equivalent to 3 years purchase of the super profits. So automatically how much would be the super profit of 1 year? That is 50,000. See, very simple. 3 years purchase of the super profit is 1,50,000. So automatically for 1 year how much it is? 50,000. So the total profits comes how much for that? Very simple. Super profit is 50,000. Then the total profit is, that is actual profits are given 80,000, 1,30,000, 1,56,000 plus the super profit 50,000. So result will be here, that is 3,66,000. Here we will find out the average profit of this dividing by 3, that is 1,22,000. Now 1,22,000 is the average profit which is based upon the profit figure which is given here. Now result will be here very simply that the normal profit should be, when average profit is 1,22,000, then automatically we had a normal profit, that is super profits are given 50,000 as we had calculated on the basis of the goodwill of 3 years is given. So we would had a normal profit of 72,000. 1,22,000 minus 50,000, 72,000. Now again a question arises that we have to find out what? We have to find out the amount of capital implied. Now how much capital is implied here? How we can find it out? That we can find it out on the basis of the normal rate of return is given 12%. Here we had find it out how much is the total profits, that is 72,000. Now 72,000 is the normal profit, rate of return is 12%. So the amount of capital implied rupees 6 lakh. Very simply you take the capital implied as X into normal rate of return 12 divided by 100 because it is in percentage. So 72,000 is the normal profit as we had calculated. So this way you would find the amount of capital implied rupees 6 lakh. I would continue in my next video relating to the calculation of the goodwill by the capitalization method.